The analysis of EOG Resources Inc. (EOG) indicates that the company maintains a structurally superior position within the independent exploration and production (E&P), driven by its proprietary premium drilling strategy. This strategic commitment to capital discipline translates directly into predictable, high-margin production growth and exceptional free cash flow (FCF) generation across various commodity price environments. Despite industry-leading fundamentals, EOG shares currently trade at a material discount relative to its peers and intrinsic value estimates, presenting a compelling investment opportunity. EOG's financial model is characterized by resilience. The company focuses exclusively on drilling projects projected to yield a minimum 30% after-tax rate of return (ATRO) at stress test prices of $40 per barrel (WTI) and $2.50 per thousand cubic feet (MCF). This discipline underpins the company's ability to generate significant excess capital, evidenced by the $1.4 billion in FCF achieved during the third quarter of 2025, and a reaffirmed full-year 2025 FCF forecast of $4.5 billion. Operational execution remains strong, demonstrated by Q3 2025 total production volumes of 1.301.2 thousand barrels of oil equivalent per day, (MBOED), exceeding management guidance alongside per-unit cash operating costs that fell below guidance midpoints. From a valuation perspective, EOG trades favorably compared to its peer group, carrying a forward price-to-earnings ratio (PE ratio) of 10.8x, which is a notable discount to the estimated peer average of 13.1x. Furthermore, analysis factoring in the company's robust earnings growth potential and high profit margins suggests a fair PE ratio closer to 19.5x, confirming the current undervaluation. Corporate strategy, the foundational premium moat. A. The definition and resilience of premium drilling. The core competitive advantage of EOG Resources is its unyielding commitment to the premium drilling strategy. This strategy is defined by a rigid quantitative standard. Only capital projects expected to deliver a minimum 30% direct after-tax rate of return, ATRO, based on conservative long-term commodity prices of $40 per barrel WTI and $2.50 per thousand cubic feet, Henry Hub, receive allocation. This strict hurdle rate is considered among the most stringent in the entire E&P industry, effectively acting as a structural firewall against capital misallocation during periods of high commodity price volatility. The practice of anchoring investment decisions to trough cycle pricing ensures that EOG's invested capital remains profitable and cash generative even if market prices decline significantly. This methodology inherently de-risks the long-term asset portfolio, differentiating EOG from competitors whose capital deployment may be optimized for prevailing high spot prices, potentially leading to stranded value if prices retreat. The consistently high returns generated under this paradigm, such as the 2020 Premium Drilling Program being expected to generate over 30% direct ATRO even with oil around $30 per barrel, justifies a sustained premium valuation multiple for the equity, reflecting its financial reliability. The 2024 capital plan illustrates the strategy's effectiveness in generating capital efficiency. The disciplined program allocated approximately $4.3 billion to drill and complete 600 net wells in domestic premium areas. Critically, this plan delivered 3% oil volume growth and 7% total volume growth while simultaneously achieving a nearly $100 million reduction in total direct investment in drilling and completion activity compared to the prior year. The ability to increase production volumes while lowering development capital expenditure confirms substantial operational leverage and technological optimization within the field operations. This ratio of growth per dollar invested maximizes the generation of FCF, the primary source for the company's shareholder return programs. B. Multi-basin portfolio and strategic diversification. EOG's operational success is built on a diverse asset base spanning multiple basins, ensuring that performance is not overly reliant on the fortunes of any single play, product, or marketing outlet. The core of the portfolio remains focused on high-return liquids assets, primarily in the Delaware Basin and the South Texas Eagle Ford. The company continues to prioritize capital discipline in these foundational plays, focusing on extended laterals and optimizing returns. A key strategic move involves investing approximately $400 million into infrastructure projects related to the Delaware Basin and the Dorado natural gas assets. These investments are designed to provide long-term benefits by enhancing price realizations and lowering operating costs, signifying a strategic move toward operational maturity that bolsters sustained free cash flow superiority. Furthermore, EOG is strategically scaling its natural gas and natural gas liquids (NGL) exposure through the recent closure of the Encino Acquisition Partners (Encino) acquisition in Q3 2025, alongside a step-up in activity in the Ohio Utica play. To mitigate the inherent volatility and often depressed nature of domestic natural gas pricing, EOG has proactively de-risked its gas commitment. The company entered a 10-year Brent-linked gas sales agreement commencing in January 2027, covering sales volumes of 140K MMBTU. This measure structurally links a significant portion of future gas production to international oil-indexed pricing, providing substantially greater long-term price certainty than relying solely on Henry Hub. This stable price foundation justifies the ongoing capital commitment to developing large-scale gas plays like Dorado and integrating the newly acquired Encino assets. 3. Financial performance and operational excellence. A. Q3 2025 results and free cash flow generation. EOG delivered strong financial results for the third quarter of 2025, demonstrating effective integration of the Encino acquisition and sustained cost discipline. Key financial and operational metrics Q3 2025. Metric: Q3 2025 value. Adjusted net income, non-GAAP, $1,472 million. Adjusted earnings per share, EPS, $2.71. Adjusted cash flow from operations, CFO, $3,031 million. Free cash flow generated, $1,383 million. First quarter crude oil and condensate production, 534.5 MBOD. Total crude oil equivalent production, 1,301.2 MBOD. LOE cost per BOE, $3.60. Non-GAAP G&A cost per BOE, $1.43. Forecasted full year 2025 FCF, $4.5 billion. Source: EOG Financial Reports. The company reported adjusted net income of $1,472 billion, translating to $2.71 in adjusted EPS. Most importantly for investors focused on sustainability and returns, EOG generated $1,383 million in free cash flow. This strong quarterly performance led management to update its full year 2025 FCF forecast, raising it by $200 million to $4.5 billion. Operationally, the results confirm superior execution. Total production volumes reached 1,301.2 MBOED, while crude oil and condensate production hit 534.5 MBOED. Both figures exceeded the company's guidance midpoints for the quarter. B. Cost structure analysis and integration efficiency. A significant driver of EOG's FCF superiority is its ability to maintain low, stable per-unit operating costs, a metric crucial for margin stability. In Q3 2025, EOG reported lease operating expenses (LOE) per BOE of $3.60, which was below the guidance midpoint of $3.70. Similarly, non-GAAP general and administrative (G&A) costs per BOE were $1.43, lower than the guidance midpoint of $1.50. The management indicated that the quarter-over-quarter decrease in both LOE and G&A per BOE was primarily attributable to the benefits of higher production volumes achieved through the integration of the Utica and Encino assets, along with lower workover and employee-related expenses. This relationship confirms that the strategic acquisition of Encino is immediately accretive to the corporate cost structure by introducing economies of scale, validating the financial rationale behind the transaction. In terms of price capture, EOG's strategic focus on optimized marketing and infrastructure yielded tangible benefits. The company realized a $1.02 per barrel premium above the WTI benchmark price for its U.S. crude oil and condensate. This ability to consistently sell production at a premium to the benchmark demonstrates that EOG's investments in midstream infrastructure and marketing capabilities successfully translate into higher realized revenues per barrel of oil equivalent. 4. Balance sheet, liquidity, and capital return framework. A. Investment-grade credit profile and leverage management. EOG maintains one of the strongest balance sheets in the energy sector, providing crucial financial protection during volatile markets and enabling strategic investments across cycles. The company possesses an investment-grade credit rating supported by customary covenants related to maintaining a low total debt to total capitalization ratio. EOG's leverage philosophy is anchored by the highly conservative target of achieving total debt at less than 1 times EBITDA at bottom cycle prices, $45 WTI, $2.50 Henry Hub. While EOG typically runs a net cash balance, the acquisition of Encino Acquisition Partners led to a temporary shift in the capital structure during Q3 2025. This transaction required a $3.5 billion debt offering. As a result, the balance sheet shifted from a net debt position of negative $980 million net cash in Q2 2025 to a reported net debt position of $4.164 billion in Q3 2025. Despite this increase in debt, the total long-term and current debt stands at $7.694 billion, against a substantial cash position of $3.530 billion. The resultant net debt to total capitalization ratio of 12.1% remains exceptionally low and conservative, firmly establishing the company's financial stability and maintaining its investment-grade status. Sustainable shareholder return policy. EOG's capital allocation framework prioritizes a sustainable and growing regular dividend supplemented by opportunistic share repurchases, all funded by durable free cash flow. The regular dividend is the primary mechanism for returning cash to shareholders. EOG boasts an exceptional track record, having never suspended or reduced its regular dividend in 27 years. The dividend was recently set at an indicated annual rate of $4.08 per share, representing a 5% increase announced in tandem with the Encino acquisition. This increase signals strong management confidence in the future FCF generation capacity of the combined assets. Excess FCF is deployed through share repurchases to provide incremental cash returns. During Q3 2025, EOG repurchased 3.8 million shares for $440 million. The company maintains substantial flexibility for future opportunistic buybacks, with $4.0 billion remaining under the current share buyback authorization. The sustained commitment to reducing the share count, the company has repurchased approximately 9% of outstanding shares since initiating buybacks in 2023, serves as a strong validation for management that the stock is undervalued, aiming to enhance future EPS growth and narrow the current market valuation gap. EOG is committed to returning at least $3.5 billion to shareholders in 2025. V. Reserves and inventory quality. A. Proved reserve base, P1. Composition. The quality and composition of EOG's proven reserves are central to its long-term stability and reflect its strategic focus on high-value liquids-rich assets. As of December 31, 2024, EOG's total estimated net proved reserves, P1, were 4,748 million barrels of oil equivalent, MMBOE. The reserve composition is weighted toward liquids, which command higher average realized prices. Crude oil and condensate, 1,870 million barrels, 40% of MMBOE. Natural gas liquids, 1,358 million barrels, 29% of MMBOE. Natural gas, 1,520 million barrels equivalent, 31% of MMBOE. The high liquids weighting, 69%, ensures that EOG captures the majority of its revenue from the more stable crude oil market, while the substantial natural gas component provides scale, particularly given the strategic de-risking outlined below. Crucially, approximately 99% of EOG's net proved reserves are located within the United States. This domestic focus provides maximum security from geopolitical instability, local political risk, and expropriation concerns common to international E&P operations, contributing to the perceived safety and stability of the underlying assets. B. Long-term inventory and commodity sensitivity. The sustainability of the premium drilling strategy hinges on EOG's continuous success in identifying and proving up premium inventory. The company has historically demonstrated this capability by adding new high-return plays such as the Delaware Basin First Bone Spring, thereby ensuring a long runway of future profitable investments that meet the strict 30% ATRR hurdle. This rigorous selection process ensures that the long-term reserves are consistently high quality, maximizing the profitability of the overall asset base. Given the scale of its production, EOG maintains sensitivity to commodity price fluctuations. Specifically regarding natural gas, the company estimated that for every $0.10 per MCF increase or decrease in the natural gas price, net income is affected by approximately $33 million, and pre-tax cash flows from operating activities are affected by approximately $42 million. This inherent sensitivity is the driver behind the company's strategic shift to secure better gas marketing arrangements. The commitment to the 10-year Brent-linked gas sales agreement starting in 2027 is a critical mechanism for minimizing the impact of domestic Henry Hub volatility. By linking future large-scale gas volumes to the generally higher and more stable Brent benchmark, EOG secures a structural buffer against depressed domestic gas prices, significantly de-risking its multi-basin strategy and justifying the increased capital focus on plays like Dorado and the newly acquired Encino assets. V. Valuation and competitive analysis. EOG's current market valuation metrics suggest the market has yet to fully appreciate the superior cash flow stability and operational efficiency provided by the premium drilling strategy, leading to a demonstrable undervaluation. A. Comparative valuation benchmarking. EOG's key valuation multiples trade at a substantial discount to both its immediate E&P peer group and the broader U.S. oil and gas industry average, despite superior balance sheet strength and capital discipline. EOG's forward PE ratio of 10.8x is 17% lower than the calculated peer average of 13.1x and significantly lower than the broader U.S. oil and gas industry average of 14.2x. Similarly, the trailing 12-month TTM enterprise value to EBITDA, EV/EBITDA, of 5.58x is exceptionally low, representing approximately half of the broader industry average of 11.03x. Analysis of the intrinsic value confirms this undervaluation. The calculated fair PE ratio, which takes into account EOG's specific blend of estimated earnings growth, approximately 7.95% per year, high operating margins, around 32%, and conservative risk profile, is estimated at 19.5x. The vast gulf between the current trading PE, 10.8x, and the intrinsic fair PE, 19.5x, provides a powerful quantitative indicator of the market's mispricing. If EOG continues its track record of efficient growth and superior free cash flow generation, a substantial multiple expansion is highly probable as the market re-rates the stock toward this intrinsic valuation. B. Analyst consensus and price targets. Wall Street analysts are largely unified in their assessment of EOG's strong fundamentals and the resulting potential for upside appreciation. The consensus average analyst price target is $139 per share, which suggests a potential upside of approximately 30% from the recent trading levels near $107 per share. The range of analyst price targets is significant, reflecting variations in future commodity price forecasts, but the overall sentiment is overwhelmingly positive. Recent target prices range from a low of $114 to a high of $173, with a median target of $138. The consensus rating is dominated by positive views, including 13 buys and 3 outperforms, compared to only 1 underperform rating. This strong analyst conviction reinforces the view that EOG's long-term efficiency and shareholder return profile are being significantly undervalued by the current market price. V. Investment risks and mitigation. While EOG benefits from robust internal defenses against commodity cycles, standard external risks inherent to the E&P sector warrant consideration. A. Commodity price volatility and geopolitical risk. The primary risk to EOG's performance remains global commodity price volatility, driven by supply-demand imbalances, OPEC+ actions, and escalating geopolitical tensions that could disrupt trade and investment flows. A rapid, unforeseen collapse in oil or gas prices would negatively impact realized revenues and the quantum of free cash flow generated. EOG's strategy proactively mitigates this risk through two layers of defense. First, the premium drilling strategy guarantees that capital projects remain economically sound, generating high returns even if WTI prices settle back toward the 40 floor. Second, the company's extensive domestic reserve base, 99% U.S. located, provides inherent protection from the direct geopolitical turmoil associated with international operations. The recent implementation of the Brent-linked gas sales agreement further structurally de-risks the gas segment of the portfolio. B. Regulatory and environmental headwinds. The E&P industry faces extensive regulatory oversight at the federal and state levels, particularly concerning environmental protection, safety, and operational standards. Future legislative changes or increased scrutiny regarding climate change could necessitate greater compliance costs, impacting operating margins. EOG addresses this risk proactively by integrating compliance into its long-term strategic planning. The company's commitment of $400 million to strategic infrastructure projects is designed not only to improve margins, but also to enhance operational efficiency and environmental performance, positioning EOG favorably to navigate evolving ESG and regulatory landscapes. C. Execution risk and inventory replenishment. A key concern for any growth-oriented E&P company operating under a restrictive capital model is the continuous successful replenishment of high-quality inventory. If EOG fails to prove up new drilling locations that meet the stringent 30% ATR hurdle, it could be forced to either accept lower future returns or reduce capital expenditure, thereby compromising its modest production growth targets. The company's sustained track record of capital discipline and operational efficiency, evidenced by the successful integration and immediate cost benefits derived from the Encino acquisition in Q3 2025, suggests that EOG possesses a sophisticated and successful internal exploration and development process capable of maintaining inventory quality and operational momentum. 8. Conclusion. EOG Resources is a structurally advantaged independent E&P company characterized by unwavering capital discipline, superior operational efficiency, and a fortress balance sheet. The premium drilling strategy serves as a critical moat, ensuring that all invested capital generates high returns through market cycles, leading to the predictable generation of robust free cash flow. This FCF fuels a highly attractive cash return policy centered on a sustainable, growing regular dividend and opportunistic share repurchases. The current market valuation, characterized by a forward PE multiple significantly below the company's implied intrinsic value and peer average, represents a distinct opportunity for capital appreciation. The combination of conservative capital allocation, high-quality inventory, successful integration of accretive acquisitions, Encino, and strategic de-risking of its gas exposure, Brent-linked sales, provides a compelling case for investment.